Hi, everyone. Welcome to the Week 1 live chat, part number 1 for Finance 4424 Case Studies in Finance. Dr. Dennis here. Delighted to once again be facilitating your learning adventure here as we delve into a business finance course that's a little bit different from your other courses. So, case studies, well, let's just say it's different, and I'm going to get you set up for success. So, follow along with me. So, welcome once again to our first interactive session this week. And as we venture into the world of business finance case studies, our focus will be on the practical applications of theory, which requires you to integrate your knowledge into some real world scenarios. Think of case studies as a test of your analytical and decision making skills that you have developed thus far through your other courses. It's an opportunity to show what you know. It's very important that you read each case study multiple times. This iterative process will enhance your comprehension and analytical depth. So, for example, on your first read, just get the lay of the land, understand the context, who the players are, which finance principles are at play, and this overview is essential for framing your subsequent analysis. Your second read through for each case is about drilling down into specifics. So here, identify the key questions and problems posed by the case. Pay attention to the financial data and the situations presented. These are the points around which your analysis ultimately will revolve. The third read is for your detective work. Each detail can be a clue to a deeper understanding of the case. This is also the stage to identify any additional resources that could illuminate the case further. These might include financial reports, industry analysis, or theoretical frameworks. Note-taking will be critical. It's not merely about recording facts, but about mapping out your thought process for each case. Your notes should reflect a progression from understanding the case background all the way to formulating potential solutions. Yes, it's quite possible you may come up with more than one solution for each case. It will be up to you to decide which is the best course of action. As we proceed through various case studies, remember that each case is unique. What may have worked for one company might not work for another. This course will challenge you to not only use your financial knowledge, but also to think critically and creatively. So I encourage all of you to embrace the complexity and the occasional ambiguity of these cases. The answer is not always obvious. This approach will help prepare you for the unpredictable nature of financial decision making in real world business environments where the answers are almost never in the back of the book. Some more tips on how to successfully perform a case study. Defining the problem will be the cornerstone of any case study analysis. It requires you to distill the complexities of the case into a clear statement of the central issue. Crafting a problem statement sharpens your focus and will help guide your research. Creating an outline is the next critical step. This outline should serve as a roadmap for your analysis, showing a logical progression from problem identification all the way to the eventual solution. You are encouraged to think of it as a skeleton on which the case study flesh will hang. I know that sounds a little gross, but it's a pretty good descriptor. You should include the power of spreadsheets for your financial models. Tools such as time value of money, weighted average cost of capital, internal rate of return, and cash flow analysis, in particular discounted cash flow analysis, are essential for a thorough financial analysis. You should understand that these models are not just academic exercises. They are the same tools used by financial professionals to make real-world decisions. I highly encourage you to explore well beyond the textbook for information. Although the textbook provides foundational knowledge, real-world finance often requires additional contemporary data. Use the resources available at the Keiser Library on www.keiserlibrary.com for current industry information and data that can provide richer, more relevant analysis. In particular, I think you will benefit from using the EBSCO host database and the ProQuest database. Get to know those. If you've made it this far in your academic career without examining these databases and searching for peer-reviewed journals, professional periodicals, now's the time to do it before you graduate. Also, be mindful of the course announcements. Watch them closely. As your professor, I will provide curated tips and insights from time to time that can guide your research and analysis, and hopefully offer a layer of instruction that supplements your own independent work, with emphasis on independent work. Finally, be sure to carefully review textbook pages 23 through 29. That's in the lowercase Roman numerals, XXIII through XXIX, for those of you who didn't learn your Roman numerals. Read those pages. There are that fine print stuff at the beginning of the book that everybody skips over. If you skip this course is going to be much, much more difficult. Read those textbook pages with the Roman numerals shown here. It provides super, super valuable tips on case study analysis. Your textbook is a valuable resource that provides detailed guidelines and examples on how to approach the case studies methodically. However, you must also do research outside the textbook. As you complete each case, integrate a variety of resources, class materials, external databases, spreadsheets, and of course your instructor's insights to build a well-rounded and informed case study. The first case study for this course is an examination of the financial strategies and decisions taken by Warren Buffett, specifically in the year 2015. If you're not sure who Warren Buffett is, he is recognized globally as one of the foremost investors with a long-standing history of success through value investing and as the chairman and CEO of an investment management firm known as Berkshire Hathaway. The year 2015 is a focal point for this case due to its distinctive market conditions and economic factors that influenced investment decisions at that time. Mr. Buffett's approach during this year illustrates the challenges encountered by investors, including market volatility and strategic investment choices that need to be made under such conditions. This case study provides insights into risk management, portfolio diversification, and the pursuit of long-term value, which are integral to business finance and investment strategies. An analysis of Buffett's 2015 investment strategy reveals some key lessons in financial decision-making which are applicable to various roles within the finance sector. Understanding Buffett's investment philosophy offers a deeper comprehension of the thought processes that guide seasoned investors beyond just the technical aspects of financial analysis. Accordingly, it is crucial to not only recognize the success of Buffett's strategies, but also to critically examine their transferability and potential adjustments required to suit different investment contexts and personal philosophies. The case under consideration involves Berkshire Hathaway's acquisition bid for another company called Precision Castparts Corporation, or PCP. This will require us to conduct the simplified valuation of PCP to understand the financial implications of the bid. The valuation of PCP is an essential exercise to help evaluate the reasonableness of Berkshire Hathaway's offer. Various valuation methods, such as discounted cash flows or comparables, may be applied to determine if the bid reflects the intrinsic value of PCP. Scrutinizing whether Berkshire Hathaway's offer for the purchase of PCP is reasonable involves analyzing the offer price against the valuation. Factors to consider include Precision Castparts' financial health, growth prospects, and the premium Berkshire is willing to pay over and above the market price. Warren Buffett's investment philosophy and Berkshire Hathaway's track record are instrumental in assessing this transaction. Buffett's approach, which emphasizes long-term value and robust business models, is expected to have influenced the decision to purchase Precision Castparts. The significance of Buffett's investment philosophy in this transaction lies in its potential impact on the valuation and bid. His historical preference for undervalued companies with a strong competitive advantage might suggest a strategic fit with PCP's business operations and financial profile. Understanding the rationale behind this bid requires us to align Precision Castparts' attributes with the typical characteristics Buffett looks for in an acquisition, such as consistent earning power, good return on equity, and capable management. This case study invites you, as the student, to dissect the bid not just from a numerical standpoint, but also considering the qualitative aspects that Buffett values, and then to debate whether this transaction aligns with the broader strategic objectives of his firm, Berkshire Hathaway. Let us next consider who is Warren E. Buffett. Often referred to as the Oracle of Omaha, he is a prominent figure in the world of investing, known for his acumen and successful track record in the stock market and as the chairman and CEO of Berkshire Hathaway. His investment philosophy has largely been characterized by a focus on value investing, long-term horizons, and an emphasis on companies with strong fundamentals and sustainable competitive advantages. Buffett is also a prolific writer and thinker on topics of corporate governance, economics, and investing. His writings, particularly the essays of Warren Buffett, Lessons for Corporate America, compile his insights and philosophies on business and investing. These essays are a compendium of his annual letters to Berkshire Hathaway shareholders and provide a deep dive into his investment strategy and thoughts on corporate America. The annual letters to shareholders are particularly known for their candidness, wit, and wisdom, offering invaluable lessons on investment and management. They have been written by Buffett for over half a century and are widely read by investors and business professionals worldwide for guidance and inspiration. You are highly encouraged to locate and download these sources. As you analyze these resources, one can gain a comprehensive understanding of Buffett's approach to investing, his decision-making process, and his perspectives on the economic landscape, all of which are crucial for anyone seeking to grasp the principles of successful investment. As students of the business world, you are encouraged to explore these resources to better understand the context of Buffett's investment decisions and to extract lessons that can be applied to your own investment strategies. Evaluating Warren Buffett's success rate is pivotal in understanding the impact of his investment strategy and philosophy on the actual performance of Berkshire Hathaway. The compound annual growth rate of Berkshire Hathaway from 1975 through 2015 stands at 20.8%. This metric is a testament to Buffett's investment acumen, significantly outpacing the average growth rates achieved by large firms in the same period. For comparison, the average annual return for the S&P 500, often used as a benchmark for large firms, is historically around 10% before inflation. Buffett's ability to double this benchmark demonstrates an exceptional level of success in value creation. The success rate of Buffett and Berkshire Hathaway is not only a measure of financial performance, but it also reflects the effectiveness of their investment decisions and the robustness of their business judgment. As you examine Case Exhibits 1.3 and 1.5 from the course textbook, Case Studies in Finance by Bruner, Eads, and Schill, you can further analyze Buffett's investment strategies against other case studies and financial theories. The textbook, of course, provides context as well as empirical evidence that can enable a deeper appreciation of Buffett's strategic approach to investments and the factors contributing to his long-term success. Who is Berkshire Hathaway? Well, Berkshire Hathaway is a conglomerate holding company spearheaded by CEO Warren E. Buffett, which oversees and manages a diverse range of subsidiary businesses. Another way to think about Berkshire Hathaway, it is a business of other businesses. The success of Berkshire Hathaway is not just the product of its leadership, but also stems from the collective performance of its subsidiaries. The companies within Berkshire's portfolio range from financial services to consumer goods, each contributing to the conglomerate's overall success. The investments made by Berkshire Hathaway have been strategic and highly diversified. This slide illustrates significant holdings in major companies such as American Express, Coca-Cola, and Wells Fargo, among others. One notable aspect of Berkshire Hathaway's investment strategy is the significant gains realized from these holdings. For instance, the investments in American Express Company and the Coca-Cola Company show gains of 21% and 25% respectively, indicating Buffett's skill in choosing companies with robust growth potential. A comparison of the cost to current market value of these investments highlights the substantial value appreciation over time, reflecting Berkshire Hathaway's successful investment approach. The Case Exhibit 1.4 in the course textbook will provide a detailed breakdown of these investments, allowing you to analyze which businesses have driven most of Berkshire's success and how this relates to Buffett's investment philosophy. The diversification of Berkshire Hathaway's investments is a crucial factor in its risk management strategy, balancing potential losses from one holding with gains in another, as shown by the mixed performance of the investments listed here. Understanding the distribution of gains across the portfolio provides insight into how Berkshire Hathaway sustains growth and profitability, underlining the importance of investment selection and portfolio management. Buffett's investment philosophy. Warren Buffett's approach to investing has often been characterized by his cautious stance on diversification. While conventional wisdom advocates for diversification as a way to mitigate risk, Buffett has expressed a belief in concentrating investments in high-quality assets that one understands well, rather than spreading out investments too thinly. An examination of his investment holdings, as detailed in Case Exhibits 1.2 and 1.3, reveals a portfolio that may seem diversified across industries, but is actually focused on a relatively small number of high-conviction bets. This strategy is consistent with his philosophy of, quote, putting all eggs in one basket and watching that basket closely, unquote. In considering whether Buffett's portfolio management is passive or active, it is evident that while he holds his investments for long periods, akin to a passive strategy, he chooses his investments with an active and discerning eye for enduring value and engages closely with the management of the companies in which he invests. Buffett's access to information and his deep understanding of the businesses he invests in allows him to make well-informed decisions. His status and reputation also provide him with unique access to deals and opportunities that average investors may not have. This is a key point. You should carefully explore the case exhibits to critically evaluate how Buffett's investment holdings and strategies reflect his public statements on diversification and to understand the nuanced application of his investment philosophy in practice. So what does the market really think about all of this? Market perception is a critical factor in the valuation of any acquisition. The market's response to Berkshire Hathaway's bid for Precision Castparts Corporation can be indicative of whether the investment community believes Berkshire is paying an appropriate amount for PCP. Analyzing market sentiment involves looking at changes in stock prices, analyst reports, and commentary around time of the acquisition announcement. These changes can reflect the collective judgment of investors regarding the fairness of the deal price. The question of whether the deal will create or diminish value for Berkshire is central to the investment thesis. Value creation is often assessed through the potential for synergies, earnings accretion, and the strategic fit of the acquisition within Berkshire's existing portfolio. To determine if Berkshire is enhancing its value through this acquisition, it is crucial to examine Precision Castparts Corporation's financials and future cash flow projections. The discounted cash flow, or DCF method, is a robust tool in this regard, as it considers the present value of expected future cash flows, which can shed light on the intrinsic value of PCP. Focusing on discounted cash flow allows for an analysis grounded in fundamental finance, providing a clear framework to evaluate whether the acquisition is expected to be accretive to Berkshire's value. A thorough analysis should also consider how the acquisition aligns with Berkshire's long-term strategy and whether the market believes Buffett is leveraging his investment principles to secure a deal that will deliver returns above the cost of capital. This concludes part 1 of the week 1 live chat discussion. As always, if you have questions, please contact me directly via email, or you may call or text using the number shown on the slide here. Stay tuned for more and watch the announcements closely for additional information regarding the course and your upcoming projects.